Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets.
I'm Joann Spadigam, European rate strategist, and I'm joined today by our global market specialists, Paul Robson and Stuart Sparks. There's been a lot for markets to digest over the last week, including UK and US data, trade talks, Middle Eastern tensions, and supply. But I think let's start first closest to home with the UK. Paul, we've got a range of UK data this week. We've talked about sticky inflation in the past in this podcast, but what did you make of this week's labour market and growth data?
Well, truth be told, I think the data that we had out of the UK was pretty poor, both the labour market data that we got this week, but also the GDP numbers. But I think the key takeaway for markets, and when we think about the data, is to what extent you have confidence in the actual data that we receive, because both of them came with that different types of health warning, or the actual details were just a little bit hard to square with other data. Now, that doesn't mean that the data that were published will ultimately not be a true reflection of the performance of the economy, but it does provide a little bit of doubt at this important time in terms of central bank policy, just at the time when you really need a good steer on the economy. Maybe the data perhaps not giving you the information that you or the central bank requires. So in terms of the data, a lot of focus was on the labour market numbers, the wage data, a little bit softer than expected, but it was this drop in employment of just over 100,000 workers in April, which caught the attention. This is the sort of payroll number. This is companies telling the revenue how many employees they have that will be paying tax. So at first cut, you would have thought that that was quite a straightforward measure. The fall of just over 100,000, if you think about, put that into context, if this was the US economy, which is 4-5 times as large as the UK, we'd be talking about a payroll decline of 400,000. So it's a significant miss to the downside. But the ONS themselves said that they had some doubts about the data. The sample was a little bit earlier in the month. Maybe the data will get a little bit better on revision. And these numbers are revised. They're not set in stone. A couple of other things to note about the data in terms of employment is that it didn't seem to be that consistent with other indicators of the labour market, survey data in particular. So it stands out a little bit. And also that we had moved beyond the initial hit to the labour market, we thought, from the national insurance contribution change, national minimum wage. So again, maybe it's the impact of tariffs, maybe it's a delayed impact of reaction to high wages and taxes, but nevertheless, I think we need to be a little bit cautious. The other point about the data, and this was actually a point one of my colleagues pointed out to me, that the actual weakness in the labour market wasn't necessarily about people losing their jobs. It was more about hiring became more cautious. So there's always a sort of natural outflow from employment. People retire, for example, to go and do other things. And you've also got people that are entering the job market getting jobs. And it was actually the hiring bit was that flat, and people leaving jobs was in line with what you'd normally expect. So that maybe makes it a little bit better. In terms of the other data, we had GDP data. I won't go into a lot of detail, but output of the UK economy slipped unexpectedly in April, so at the same time as those weak jobs numbers. But if we delve a little bit deeper into the month-on-month changes, again, it didn't really jive that well with other indicators. So, for example, there was a weakness in retail and wholesaling, but retail sales numbers were really quite strong during that month, and normally that correlates really quite closely with each other. And then also professional services in the economy was weak. That was put down to stamp duty in the housing market. But activity in the housing market during April was actually relatively strong. And it wasn't like growth had been really strong in that sector running up to the stamp duty change. So I think we just have to be a little bit cautious on what were a set of very weak data at first cut.
There was also some focus on the spending review this week. You've said before that it's really only about cutting up a pot of money, essentially, but did you get anything surprising from the spending review at all?
No, not really. Our expectations were pretty low, and those expectations were met, as you quite rightly pointed out. This was about dividing up a pot of money that was already known. And equally, the spread across the economy wasn't much different from what had been well trailed. So NHS got more money, Defence got some more money. There were some headlines around infrastructure spending, nuclear power, for example. But really, this isn't going to change the outlook for, say, the economy or for the gilt market in quarters to come. I think, but the way I look at the spending review, and as I mentioned in last week's Bondcast, it's about whether you think that some of the non-protected departments and their spending plans are actually credible. And this has been a theme over the last sort of year in the UK, that tax receipts have actually been a little bit stronger than expected, but so has spending. And the government has struggled to keep a firm grip on spending. So I think it means that you have to watch the borrowing numbers particularly carefully through the summer into that next fiscal event, which will be the autumn budget, and let's see where we are there. We think that there'll probably be pressure on spending cuts and revenue raising measures as well, but let's wait and see.
So switching tacks a little bit and looking forward into the next week, we've got the Bank of England meeting to come. Has the data this week shifted anything, you think, in terms of your view for next week's meeting or the meetings to come?
Yeah, I think it's supportive of our view about what comes later. In terms of next week's Bank of England MPC meeting, anything other than unchanged rates would be a big surprise to us, and more importantly, a big surprise to markets, which aren't really looking for any change in policy. Just a few basis points is their expectation, so essentially zero. I think the focus for markets will be again on the vote count and on the guidance, and that would be coming from the minutes. We think that the vote count will be 7-2. There'll be another 2 people that want 50 basis point cuts in the policy rate, we think, whereas the others are happy with unchanged rates at this meeting. But I'll be looking for any comments in the minutes about how the members who voted for rate cuts last month, are they still seeing the decision as finely balanced? Because we've had some higher than expected inflation numbers. You referenced those at the top of the podcast. We've had some kind of de-escalation in trade tensions. It still lingers. As we said last week, you sort of get escalation, de-escalation, re-escalation, and the outlook is uncertain. But I think for this central bank, I think they maintain their guidance of rates are going to be moved gradually and carefully. I always mix up carefully and cautious, but it's carefully and gradual, and I don't think that changes. In terms of the outlook, we think that front-end rates are now better priced for our base case. We think that you get 2 quarter-point cuts in interest rates, one at the August meeting and the next in November. Markets have moved to price that base case with more confidence. Just 2 things to note there, I think. Markets are now pricing a terminal rate of 350 in the policy rate. I think that if we go much lower than that, I think that would be a fade. We have 375, although that's based on the employment numbers not weakening significantly, and that's why this week's data were important. And also intra-meeting cuts as well. We think that's a bit of a fade. We think that the central bank will go at a quarterly pace in line with that gradual and careful pace. But if people price back-to-back meetings cuts, I think that would also be a fade.
And I guess to just wrap things up on the UK side, how does all of this square with your current view on gilts and the gilt market?
Yeah, so we maintain a cautious view on gilts, both outright and cross market. We still think that the curve, certainly like 2s, 10s can steepen, but I think also long end yields also go higher. I think the weak growth numbers, I mean, it just plays that idea of higher spending and lower tax revenues and potentially pressure on borrowing. And we continue to worry about this mismatch between supply and demand. At some levels, the outlook for gilts is pretty simple. You know, you have a given supply, you probably get more supply than you currently projected. But where is the demand at a time when lots of governments and debt offices are issuing to the market, and it's just that competition for demand. And I think ultimately it means yields go higher. So we hold to that 475 percent target, but I wouldn't be surprised if we're testing that through that fiscal event come the autumn. So maybe I can quickly turn the tables back on you. So I saw reports of Dutch pension reform. It seemed to be causing a flattener in rates. I was just wondering what you thought about that and what you thought about the transition to policy changes.
Yeah, so the Dutch pension theme is an interesting one. We've had so much back and forth on that and questions around whether transition would happen or be delayed for the last many months of the year. I think from my perspective, the shift that we've got essentially is allowing Dutch pension funds some more time to adjust their interest rate hedging. So they've got a year now to adjust that. So that does mean that transition is going as per. It probably just changes the timeline for when the hedging shifts in the years to come. So our thinking was always that it would only be towards the end of this year or towards the end of next year when the biggest pension funds were transitioning, when we would see the largest market moves. And that's probably still the case, but there's probably a larger period of time where we could see transition effects happening. I think either way, when I think about forward starting long dated swaps, the inversion between long dated 10-year and long dated 30-year swaps, for example, needs to be corrected either way. The pension fund transition story is one that is important for longer term structural drivers of the swaps market and the sovereigns market as well, versus a one time only near time factor. I think that theme will continue to hold and play out in the many years to come. So I think for now it doesn't mean very much. I think very little information is known about how exactly the pension fund transition will happen and about what every single individual pension fund will do. They probably all have a little bit of a different approach. So I think that it keeps the pension fund transition themes and pension fund transition trades still very much live for now.
Also, in terms of steepeners, I mean, I continue to favour steepeners here in the UK. I know that you've been an advocate of that in Europe. What are your conviction around that, given the moves that we've had?
So I think it's pretty interesting. My steepener view continues to hold, and I think that it's still very much a consensus view amongst market participants. Flattening seems to bring with it an impetus to get back into the steepener. So my conviction here is still strong. I do get asked quite a lot what would drive a flattening or what would make my view essentially wrong. I think here what I think the biggest factors are not necessarily European factors. I think it could be the US, Japan, other markets that can drive a flattening versus a European specific story. In Europe, the front end narrative is very well known. There's still questions around trade and what that looks like with the US, which will mean that front end rates remain pretty pinned. They're a bit below our 2% target, but that will remain in the near term. Trump is threatening unilateral action. And of course, I think much remains to be seen on what the EU gets out of the trade deal, while supply risks are clearly to the upside. The global factors that it can impact that, for example, is our Fed view, where of course we have this idea that the Fed doesn't cut rates at all this year. So perhaps a US-driven flattening can have some spillover into the euro area. There's an idea that Japanese the Japanese will shrink the issuance of their debt. And whilst I think that's not so relevant for Europe, that could have an impact based on correlations. So net, I think that there could be some cross-market impact leading to flattening in Europe. But I think ultimately the key structural themes and the key drivers of European curves mean that a steepening is more likely than not. So switching a little bit and thinking about the US on the other side of the pond, we have also had some US CPI numbers this week, which were weaker than expected. How does that square, Stuart, with your views on US rates at this point?
Well, I think there are a couple of issues here. One is, so the inflation data has come in a bit weaker than expected, both in CPI, today PPI, including components that will go into PCE. And so does that change our view? Absolutely not. I mean, we still are going to be seeing core PCE year-on-year numbers above 3%. In fact, Secretary and former Fed Chair Yellen was just on the financial news reiterating this point. I think our view is now that the next hurdle for the Fed and the market is to explain the process by which it will discern between actions that are needed and not needed with respect to each individual pillar of policy. So, this is the thing where they assess where they're closest to target, and that's clearly growth. Inflation is still a problem. And in spite of this weak data, I mean, we have a fairly extraordinary set of circumstances where tariffs are being are being implemented. There is a historically strong pricing power at the moment, and we have a weaker dollar. So whereas normally the dollar would be offsetting to some extent the inflationary impulse for the U.S., it's actually amplifying it at the moment. So the short answer to the question is no, it hasn't changed our view at all. We still think the Fed is on hold. We put our forecasts, which are quite reasonable and not dissimilar from the Fed, into the Cleveland Fed's 8 policy rules, and we get a median rate trajectory, which is actually upward sloping, i.e. tilted up over the course of the next 12 calendar months. So we think that the Powell Fed is done cutting rates for the rest of his term, and are still, looking to next week for some validation of this. What will we see next week? I think that the important point is how many cuts the dots show. We think there's a strong case that it could go from 2 cuts to 1 cut. And I think that's kind of the market expectation. So we shall see. Again, our view is that this ultimately the Fed will sequentially fail to cut rates at each of the meetings between now and a year from now. And so we sort of foresee this dynamic whereby the Fed talks in a accommodative fashion, but fails to actually cut rates, just as in the 2010s, the Fed used to talk hawkish and failed to raise rates. So that's no, it's not a change in view. We are looking forward to seeing the Fed perhaps quantify or give us more insight into how much slower growth could be tolerated. Is it stall speed? Is it 1/4 of negative GDP? Any sort of guidance?
Thanks, Stuart. So a lot to look forward to for next week's Fed meeting. And of course, our Fed on hold call remains intact for now, and the markets have slowly moved on alongside that over the past weeks and months. That's it for me for this week. Thank you to our listeners for listening. If you like this episode, don't forget to like it wherever you listen to this podcast. Speak next week.